Welcome to the Personal Pension Radio podcast, where it's all about helping you complete your financial journey to retirement, discover time-tested strategies, and get unconventional insight into wealth building and retirement that actually work. Break away from the herd and go for the retirement you dream of. And now, here's your host, the income engineer, Kraig Strom.
All right, back on Personal Pension Radio. Excited for today's episode. You've seen the title, Buy a Lamborghini Instead of Saving for College. How's that for a catchy title? Well, make sure you hang in there until the end of the show. In this section, I'm just going to have a section today. It might become a regular thing. Who knows? But you'll hear about that in just a minute. Now, this is Personal Pension Radio. I am Kraig Strom, the income engineer. Now, we are broadcasting. I love when I say we. I stop and ask myself, who's we? Because honestly, there's nobody else here in the studio / workshop. And I say we are broadcasting live. Let me clarify. I am broadcasting from my workshop here in Horsetown, USA, Norco, California. This is my man cave, and I decided this would be a perfect place to actually set up the podcast studio as well. So what is Personal Pension Radio all about? So let's make sure those of you who are new to the show, thank you for being here. Regular listeners, before I forget, huge shout out and thank you to those of you who support the show, those of you who are regular listeners to the show. Truly appreciate it. Please continue to send in your questions. Please continue to share this with your friends, family, coworkers, whoever you might think to share it with. So now, what is Personal Pension Radio all about? Bottom line, optimizing retirement income. So think carefully about the message that you hear as it relates to retirement. Think very, very carefully as you listen to the messages that are out there on television, on the radio, in Money Magazine, in Forbes Magazine. If you pay attention to it like I do, just religiously, the message is all about save, 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 accumulate, and save some more. And the reality is, optimizing retirement income does not happen strictly by saving and accumulating more money or more investments. It just does not happen that way. Optimizing retirement income requires an integrated approach, a balanced approach, if you will. So, for example, I've heard people say that they can solve the retirement income situation for a person if you invest in these mutual funds and these managed money assets and so forth. Wrong. I've heard people be sold the idea that they can solve their retirement dilemma with life insurance. Wrong. Real estate? Wrong. Annuities? Wrong. The point I'm trying to make is that these products by themselves are not the solution to optimizing retirement income. Now, let me give you an example. You balance life insurance with investment assets. Now, I mean life insurance assets. I mean asset class, grade A, bank type life insurance with investment assets. Wow. You are on your way to actually building a balanced retirement income plan that can truly outperform any singular retirement product or an account. So catch what I'm saying there, please. That optimizing retirement income is not a product. It is a strategy. It is a balanced approach to multiple different assets working together really to pull the best out of each other. That's the key. They have to be in the right balance. My specialty is helping my clients, my listeners, people that ask the questions, helping you actually build that balance so you can go after maximum income in retirement. And I also want to give you hope. If you've been out there talking to someone or you've been out on the source of all knowledge, Google, searching about retirement, you have undoubtedly come across retirement income calculators. Calculators that tell you if you want to retire, you need to have this many millions of dollars to match the income that you want to have. Well, I'm here to tell you those calculators, most of the things you see online are offered by the same Wall Street machine that taught me how to teach you originally when I started 19 years ago. And I'll tell you what it is. Save more money. Save more money. Save more money. Now, I'm beating that drum today because it is so true. I'm actually meeting with someone next week, for example, that was introduced to me by another advisor. And that advisor asked this person, "What is your retirement income plan?" That was the only question he asked. What was your retirement income plan? And the answer from this very successful business owner, just as far as I understand, truly successful. This gentleman has apparently done an outstanding job at a young age. So the answer to the question, what is your retirement income plan, was, "Oh, I'm saving a ton of money. I'm saving so much money." No, that's not an income plan. That is an accumulation plan. A retirement income plan is very different and has very different rules. So if you've been out there on the internet searching for these things, you may have come across calculators and things that allow you to research or to plug in your numbers and say, well, how much income can I expect to have? And you might have been shocked at how low the retirement income number was, or how high the amount of money that you would have to reach an income level that you consider to be worth striving for. I'm here to tell you that there is a different way. I'm here to turn the light back on at the end of the retirement tunnel, but you have to be willing to stop following conventional advice. I'm going to share things with you today in this episode, for example, like I do in each of my episodes for the most case, to help you think perhaps a little differently about the material that you're consuming. We are force-fed information in a 24-hour news cycle, whether that be politics, whether it be financial. It's 24 hours a day, every single day. We are force-fed material. So how do you know when the material is right? How do you know when it could be actionable? Well, I hope that this show will continue to give you some food for thought, maybe even pause and step out of line with this conventional wisdom, this old, tired, does not work retirement planning mantra that Wall Street taught me when I started and when I was newly hatched as a financial advisor some 19 years ago. Okay, so get me all excited there. Now listen. Got to throw in a quick disclosure. Make sure that you know I am not an attorney. I am not a CPA. I don't play one on TV. I don't play an attorney. Okay? I am a certified financial planner professional. So what does that mean? It means that I went through a grueling process to become a CFP. But it doesn't mean that you should act on things that you hear on this show. This show is meant to be informational. It is not meant to be actionable for you personally. And especially, please, oh my gosh, please, do not act on things that you hear from financial entertainers or radio or podcast hosts. Okay, there's lots of good information out there, but there's also financial entertainers out there that give out maybe 98% good, basic, just run-of-the-mill advice, and then 2, 3, 4% of the time they hand out horrible advice that if you act on it, you might damage yourself in a way that you'll never know, and it just makes my skin crawl when I think about it. So please, do yourself a favor and meet with a qualified financial advisor. I would suggest, and yes, I have a bias, meeting with a certified financial planner, meeting with someone that has taken the time to go that extra mile to be certified in the financial planning world. So keep that in mind. Please don't act on anything until you've met with someone who really gets to know you and your situation. All right, first segment. Let me jump in. This is a segment I call Watch Your Step. Now, this is where I scour the news and I just look for headlines and things that catch my attention and hopefully give you I'm going to give you my perspective, and hopefully you can take that and use it to your advantage. You can use it as perhaps a filter perhaps as a balance on the scale as you evaluate other material that you might come across as you're asking questions and searching for information. The best way, truly, I am completely biased when I say this, the best way for you to judge the information and what you're thinking about is to go to Personal Pension Radio or just look me up on LinkedIn, Kraig with a K, K-R-A-I-G, Strom, S-T-R-O-M. You can find me on LinkedIn, Facebook, personalpensionradio.com. So either way, please make sure that you're getting in touch with me. That's my bias. Okay, now back to watch your step. So I'm recording this right around the time when the presidential debate 2016 is going to happen. This is the second debate. And this headline, first headline that I see when I'm sifting through the many, many different things to prepare for the podcast, it says, "How to be like Trump and avoid taxes in retirement." This is an article published in Forbes, okay? Now, right away, I am calling bull. Absolutely bull. The headline just, come on. First of all, it's totally misleading. Mr. Trump used long-standing, it's important to know, long-standing black letter tax law to carry income losses forward on his tax returns. Period. That's it. He used tax law correctly to carry tax laws forward. And here, hint, hint, he's not retired. So how in the world are we going to be like Trump and avoid taxes in retirement? Well, he's not retired, and he used a very specific section of the tax code. So that caught my interest. So let's go through it. For the folks over at Forbes, again, remember, 24-hour news cycle, websites like Forbes.com, Huffington Post, and all these, CNN and Money and all these various sites, they need content constantly. So I guess that's why they publish this kind of stuff, because I personally think this is garbage. This is just a waste of time to be out there, but the headline is very grabby. So the headline's very grabby, get you pulled in. You go, oh, I'm not going to pay any taxes in retirement. I'm going to be like Donald Trump. Well, let's go through it, okay? So here's what Forbes said. Well, let me back up. My take on things just up front, there's only one real easy way to avoid paying income taxes in retirement. You ready? Have very little income. That's it. Simple. Have very little income in retirement, no savings, no pensions, no 401ks or IRAs, just bare bones Social Security and minimum anything else. And guess what? You won't pay taxes on your income in retirement most likely until the government changes the rules. So there you go. There right up front, spoiler alert, there is a way to avoid paying income taxes in retirement. Just don't have a lot of income. All right, so let's all agree that that is not a worthy goal to strive for, right? Let's all strive for something better. So here's what Forbes published. Here's the way that Forbes publishes it. They start by saying, use a health savings account. Now, these are special types of health insurance accounts. They are high deductible accounts. They're very similar to a retirement account where you can put money aside pre-tax, where it's not taxed today, and you can use it for healthcare expenses in the future tax-free, income tax-free for health expenses. Now, here's the kicker. Most people don't have the money and the cash flow to afford, first of all, a high deductible health savings account. There's a very limited number of people compared to regular health insurance and government plans. Health savings accounts are a specialty area. So first of all, you have to have pretty good cash flow and financial situation to be able to have one. Second, this only works if you're using in retirement the health savings account for medical. Well, what if you have medical coverage through Medicare and Medicare Part A, B, Z, D, V, all those various things, and then you have money in this health savings account? Well, the Forbes article goes on to say that using the money for non-healthcare expenses after age 65, it's fully taxable. Well, okay, so there goes that, right? So it only works if you use the money for healthcare. What if you're just flat out healthy and the money just sits in there? It doesn't get used for a long, long time. The only other way to access it is for non-healthcare type issues, and then it becomes taxable. All right, the next one that they say, here's another way to avoid taxes in retirement, to be just like Donald Trump. And that's why this is all it's just terrible. As I'm reading through this, what a terrible article. Long-term capital gains rates. Oh, long-term capital gains rates. Well, what about that? If your taxable income is $37,650 or below for a single person, listen to that. If it's below $37,650 for a single person and below $75,300 for a married couple, your tax on long-term capital gains and dividends is zero. Well, congratulations. Wow, that's fantastic. So what you're saying is if I'm a single person, I just need to make less than $38,000 a year in retirement, trying to live here in Southern California if I want to stay here, right? And I can have capital gains. Oh, wait a minute. Where am I going to have capital gains from? Don't I need to have an investment portfolio? Don't I have to have some kind of a capital gains asset or, that generates dividends, or like real estate or something that might actually have capital gains? Well, geez, I'm not sure if with an income of a married couple of $75,000 a year or less, that I'm really going to be able to have much of an investment portfolio that I'm getting dividends. Oh, okay. So wait a minute. In order to get the dividends, I actually have to have investments that actually have a gain. So in order to do that, I probably have to have some kind of an investment that carries risk. And investments that have risk also have, oh, that's right, a risk of loss. And I guess I would hope that I would have gains instead of losses, but there's no guarantee of that because no one that I know of, this is me talking personally, I mean, I don't know of any even major investment firms that ever have, 2, 3, 4 years in a row where they never lose any money, right? So it's just so ridiculous to talk about. We're in a retirement discussion, and hey, there's tax-free income as long as you make less than $75,000 a year, husband and wife. And as long as you have an investment portfolio that you're taking risk with and it makes some gains, you should be okay. Then you can get tax-free dividends, tax-free capital gains. It's just so crazy to think about. I mean, how many people with income below $75,000 will be able to handle the risk of an investment portfolio like that, right? I mean, I personally wouldn't, as a financial planner professional, I would not feel comfortable making that recommendation for a husband and wife, or a single person for that matter, earning $37,000 a year. I would be more inclined to seek out guarantees, security, right? Now, the next one they talk about is home equity. Now, I perked up on this one because I partially agree with home equity as a source of retirement cash flow. But they go on in this article to cite economists, and I've heard this before, economists who consider a paid-off house as offering free imputed rent. How's that for a term? Imputed rent. Essentially, what it means is if you have a paid-off house, you don't have to pay rent on an apartment or pay for a mortgage, so it's basically like you're getting the rent for free. That's what they say. That is another load of hog swallow. How's that? Hog swallow? I don't even know what that means. Hog swallow? Anyway, it's hooey. Hey, how's that for an old-fashioned phrase? Imputed free rent. Let's talk about that. If you are renting a house and the air conditioner goes out, who pays for that? Yeah, the landlord pays for that. If you're renting an apartment and the garbage disposal blows up, floods the kitchen, who pays for that? Yeah, the landlord pays for that. When you own the house and the air conditioner goes out in the middle of the summer, who pays for that? You do. Doesn't that then mean that you now have negative imputed rent? Doesn't that mean you're completely upside down? Absolutely, right? So the idea that home equity or living in your house is somehow this fantastic rent-free benefit, wrong. An old house has old, long-standing problems and inevitably is going to have expenses that will eat into any imputed rent that you might have. Now, on the other hand, they do mention, this is where I partially agree, they do mention a reverse mortgage. So if you have a paid-off house and you use a reverse mortgage, you can actually get monthly income in the form of essentially loan payments from the reverse mortgage, and that is income tax-free, and you could get that for as long as you live in your house. So that is an actual way that you could turn your house into an income source in retirement. You really want to have, in that case, a house that is paid off or nearly paid off, and a house that you can live in, you can age in place. That means single story, level entry. No sunken living rooms, no crazy weird staircases to get into the kitchen. It needs to be an easy house that you can live and ultimately die in that house. And a reverse mortgage can be a great way to have tax-free income, tax-free income flowing into your checking account just for living in your house. Okay, now there's a lot into the reverse mortgage, and I've had a lot of call for more information on this reverse mortgage. I will figure out what to do with an episode on that in the future. Now, let's keep going. The last thing they say about this home equity is downsize your home and use the capital gains rules, which is essentially if you have lived in your primary residence 2 out of the last 5 years, a married couple can avoid paying capital gains taxes on up to $500,000. It's a pretty great deal. Okay, so it's a pretty great deal, and all is well with that. Fine. But now the big thing is, wait a minute, if we sell our house and we downside, the money from the sale, even though we might not have paid capital gains on it, now that money needs to go somewhere where we need a place to live. How do we do that without taking more additional risk investing the money somewhere? Or do we just dump it into a paid-off house and then we end up in an imputed rent situation hoping the air conditioner doesn't blow up, right? It sounds like in that situation, I don't know what you think, I know what I think, you end up with a lot more risk again. You might downsize and then you get into another house, but you got to put the money from the proceeds of the sale of that one house, you got to put the money somewhere. So does that mean you then have to take more risk? And if you're trying to get income tax free, as this article is focused on, what are you going to do for that, right? It generally means risk. Okay, so it's just not that simple. I still haven't found any place in here except for the reverse mortgage that offers legitimately kind of easy, simple to understand tax-free income that doesn't require you to live below poverty line. Okay, the last two things they talk about, and this again just blows me away how ridiculous this is. They talk about a charitable remainder trust. Like, wow, we just went into the deep end of the estate planning pool and we're talking about charitable remainder trust in an article on how to be like Donald Trump and not pay retirement taxes. This is crazy. A charitable remainder trust, just for those listening, is generally an advanced planning technique where you are actually setting up a trust, an entity, if you will, and you can donate valuable assets that have capital gains on those assets, perhaps, and you can donate it to this charitable trust that you create. and you do it in favor of a charity that you might like, and then the charity can sell the assets and not pay taxes on the sale, and the charity trust, the charitable trust, can pay you an income. And there's all these different tax strategies and so on and so forth. Well, just stop the bus for a second. A charitable remainder trust is something that here in this article is just sort of thrown out. I mean, it's just thrown in there. That is an extremely specific discussion. Now, don't get me wrong. I'm a huge fan of charitable trust planning. I think that done correctly for the in the right circumstances, charitable trust planning is one of the things that I have enjoyed the most over my career. I've worked with clients in these kind of situations. It's fantastic. I love it. But it's not a source of tax-free retirement income because the charitable trust now has to pay the donor income. And guess what? The income is taxed according to wherever the income came from. So if the charitable trust is trying to get maximum income for the donor, they might be investing those proceeds in taxable investments. And lo and behold, when they pay out those taxable investments, the donor who now receives the income pays taxes on it as if it was theirs just the same. So there's no super special black ops way to avoid income taxes because you did a charitable trust. Are there big tax deduction planning options for a charitable trust? Absolutely. They're great. They really are. But is it some permanent guaranteed way to avoid income taxes? No way. No way. It is not just cut and dry like that. Okay? And then finally, and they end with this, okay? Social Security, up to $17,000 per year without paying taxes on Social Security. I just pulled that one number out of there. Remember what I said in the very beginning, the spoiler alert? There's a really easy way to not pay income tax in retirement. Just don't make any money in retirement. Don't earn any income. So there you go. If you just earn $17,000 a year as a single person, you won't pay any taxes on your Social Security. You probably won't pay, you probably get a refund knowing the tax rules. You probably get some sort of refund that's basically taken from people who do pay taxes, right? So now, what do I think about it? Okay, let me ask you this. So I'm going to ask you a few questions, okay? Just a few. Do you believe, I want you to think carefully about this, do you believe that the government, Republican or Democrat, can avoid the monumental debt this country is under? I mean, really, do you think, no matter what, do you think they can avoid it? They've kicked the can down the road for so long. We're pushing $20 trillion in national debt, over $200 trillion in unfunded Medicare and Social Security liabilities. We are in the hole. I mean, the numbers are beyond comprehension. So do you really think that Republican or Democrat, matters not, do you think they can avoid what is coming? I personally say no. Now, who will the government go after first? People who have retirement savings in government-controlled plans, or those with assets in tax-favored grandfathered plans? Okay, now I have an actual listener question that's going to come up about these grandfathered plans, but let me touch on it a little bit. The grandfather plan is, I'm just going to jump right to it. The grandfather plan is, for example, when a tax law changes and takes away what might be considered a loophole or a benefit. Generally, those people who already have plans in place prior to the new law are grandfathered into the old way of doing things, right? So think about the questions again, just to make sure. Do you believe the government can avoid monumental debt this country's under? And who will the government go after first? People who have retirement savings in government-controlled plans, 401ks, IRAs, etc., HSAs, 529 accounts. Those are all government-regulated, controlled plans. Or will they go after people with tax-favored assets in grandfathered plans? And finally, last question on this segment. Do you believe that taxes will be higher or lower in the future? Seriously, say it out loud. Do you believe taxes will be higher or lower in the future? There you go. I have never heard anybody say, oh, they'll be lower. No, everybody believes it. Everybody knows it. So don't get lulled into this headline of how to be like Trump and avoid taxes in retirement. I got news for you. Very unlikely that you can avoid taxes in retirement because the government controls the rules on the primary taxable vehicles like 401ks and IRAs. Does that mean that I am opposed to 401ks and IRAs? Not at all. It just means you've got to position yourself correctly to be prepared for these things. That's it. You just have to be structured right. It's not one thing is the answer, okay? This final article in this Watch Your Step section, I just got to say, I'm going to be really, really simple with this because this is the New York Times, right? The New York, how sad. I have to be honest with you. I don't read newspapers anymore. It's just so sad. It's sad to see them continue to slip into irrelevance. And yet the websites, New York Times and Money and the one that I just referenced in Forbes, again, on that 24-hour news cycle, they have to publish something. And unfortunately, the quality of what they publish today is just terrible. Like the New York Times used to really publish hard-hitting, good quality stuff, and now the volume of material published by media and online is just fill in the blanks. So here's the headline from New York Times on Your Money. How to improve your retirement income if you haven't saved. Yes, that's the whole headline. How to improve your retirement income if you haven't saved. Oh my gosh, I cannot believe they actually published a fairly lengthy, bit of an article. And what I did was just said, the heck with that. I'm going to use the KISS principle, keep it simple, stupid, right? I'm talking to me. I keep it simple, stupid. I'm not talking to you. I use it myself because my mother, she used to use the KISS principle with me and my sister all the time. So I'm not going to rant too much on this one. But here's a secret. I'll tell you right now. If you have not saved for retirement, start now. Get busy. Because no retirement income plan can work if you haven't saved anything. You have nothing to work a plan with, right? But as you begin to save, please don't get suckered into this idea that you have to start with a 401k or start with an IRA. You got to go invest in stocks. Remember to build wealth and to build it with these 4 principles in mind. The 4 wealth objectives, as I call them. I've been thinking about a different title for them that fits the podcast or the content, but the 4 wealth objectives. Always seek efficiency first. Don't be sucked into something about accumulation and save without first understanding what it truly costs. What does it truly cost you? Okay? Enjoyment. How will you be able to take maximum enjoyment from that thing which you are about to engage in, whether it be an investment or savings plan or a business venture? Where will your enjoyment come from today and in the future when you might want to retire? How will that thing benefit you, right? Next, legacy. How will that item that you're going to start saving into, how will that pass to the next generation or to a charity or the causes you care about? Always consider legacy and being able to pass on your maximum legacy, whatever your legacy might be. I would hope that you would want to pass on the maximum to the causes and the people that you choose rather than to the government. And then finally, this is the one that is the stop point for any decision if you're about to make financially. Does that financial decision work under most conditions? Or is it just going to work if things happen to be perfect? Always remember, check it against these things, especially that 4th one. If your plan and your investment only works under perfect conditions, then I would caution you, especially if you have not saved for retirement, I would caution you away from that being your starting point. You really want to be careful. As you build, you've got to build with efficiency first, liquidity, security, safety. And then once you've built on a foundation of safety and security, then start investing where you can be safe, right? Now, finally, I want to go to the segment here that I touched on a moment ago. This is a listener question. What does it mean? The question is, what do you mean by grandfathered plans? They had heard this before. What do you mean by a grandfathered plan? Well, basically, this is let's use a government example, a tax example. So this is a plan that usually excludes, so when a tax law changes, they usually exclude those who already have established plans under the old rules. So a good example, the Technical and Miscellaneous Revenue Act of 1988, TAMRA, T-M-R-A, TAMRA, okay? Tax and Miscellaneous Revenue Act of 1988. This changed the tax laws specific to cash value life insurance. So after the change, cash value policies had to be funded under new guidelines because prior to the change, basically, people would be able to put virtually unlimited amounts of money into cash value life insurance, which would grow under a very tax-favored set of rules and guidelines, providing tax-free loans and tax-free dividends and tax-free death benefits, and it was huge. There was lots of people lots of wealthy people using cash value life insurance to basically create a tax-favored account. Now, the law changed and said that now, under new guidelines, you had to have a very different structure in how you funded life insurance now, okay? But those people who had policies issued before June 21st, 1988, were grandfathered under the old rules. So they benefit from the old rules and they didn't have to change anything. So if you know anybody out there who has a cash value life insurance policy, I'm talking to you millennials and baby boomers who might have parents who have policies issued before 1988 that are cash value life insurance, keep in mind, those are policies that you probably want to hang on to. Those may be extremely valuable. Okay? Now, here's another example. There is proposed legislation that's going to change a huge tax saving strategy that might go away in 2017. Now, this is an estate tax planning strategy that is set, as far as everybody knows, to go away in 2017. But if you get your planning done this year, in 2016, that planning will most likely be grandfathered in under the old regulation. You wait till next year, probably gone forever. That's in my opinion. I think it'll probably be gone forever. So that's an example of grandfathered, okay? So just here's a tip. When you hear a financial planner say, you should get this done because it may not be available next year, I would encourage you to check it out a bit. Look at it a bit before you procrastinate, because that statement is probably true, okay? And finally, I want to finish with a fun car show story. So this is a story from my car show. I host a car show every Saturday. If you want to take a look at my car show, you can see it on Facebook. Cars and Coffee Corona. Yes, I am addicted to cars. The first step is admitting that I have a problem. Okay, so we've got that out of the way. So I had a new guy come to the show. His name was Chris. And Chris came to my show with his Lamborghini Gallardo convertible. This is a hot rod supercar, V10, very cool. And his car got lots of attention, as is the case when most Lambos show up at a car show, or just about anywhere. They get a lot of looks. So I asked him, how did he end up with a Lamborghini? And he said that he had his son to thank. He had his son to thank for it. Well, that, of course, got my interest. And I asked him, okay, you got me. Tell me what you're talking about. So he said, when my son was a freshman in high school, he said, I pulled him aside and I said, son, I will make you a deal. And Chris said, son, I will buy you a Ferrari if you graduate high school with honors and get a scholarship. I will buy you a Ferrari. Now the son thought about it for a moment and said, thanks, Dad, but I'll buy my own Ferrari. I love that. That is awesome. Thanks, Dad, but I'll buy my own Ferrari. Well, Chris's son went on to graduate high school with high honors and got a full ride academic scholarship to San Diego State University. Now, with no college tuition to pay for, what to do with all that money that Chris was going to spend on college? That's right, buy a Lamborghini. So that's where the title of this episode came from. College planning. Nope. Get an academic scholarship so Dad can have a Lamborghini. Madeline, are you listening? Yeah, my daughter occasionally listens to this podcast. Guarantee you that I'm going to send her this episode for sure. That's going to wrap it up for this episode. Make sure you get to personalpensionradio.com. Transcripts are available there. If you're missing transcripts, that's just because they're in processing. You can always email me through the website or go to LinkedIn and catch me there. Okay? Remember, the future belongs to those who take action today. My dad was a police officer, and he told me and my sister that if the world falls into chaos, for example, the police won't be there to take care of us, right? The police will be busy doing their own thing. So you better be prepared to take care of yourself. So here's my caution for you. When the economic world goes into chaos, the government is not going to be able to come and save you. So take action today to put your financial house in order. Call me. I am the income engineer. This is my specialty. I live and breathe it. You've got to give it a shot. Trust me. You're going to be so excited and happy, just like my satisfied clients all the time are loving the position that they're in. I invite you to go to Personal Pension Radio and contact me there. I'll talk to you again real soon. Thanks again for listening.
Thank you for listening to the Personal Pension Radio podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you're there, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening. Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.